when you're running, a massive fund, you are going to gravitate towards the returns of the market. It's very difficult to really to add some value. And Buffett's very candid about this. I mean, he says actually in his latest letter, he refers to this. He says, one of the disadvantages of size is that it becomes very difficult to outperform.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by Tom Stevenson, Investment Director here at Fidelity, to talk about probably the most famous name in investing. Warren Buffett is a legend and a hero to many small investors, but how relevant is his investing wisdom to investors today? Before we get into that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments below. It really does help others find what we're doing here, and it means you'll get new content as soon as it is released. That all said, Tom, welcome along. I'm going to confess to feeling a little mean writing that headline, because Warren Buffett obviously is relevant from one point of view. He's a very important voice in the investing world. What I'm trying to get to in this conversation, I suppose, is an understanding of whether his great success is repeatable in the future. What can investors today take from Buffett, and what, if anything, should they leave behind? But first, before that, Tom, why are we having this conversation now, and why were you writing about Buffett this past week?
Yeah, so the reason we're talking about Buffett this week is that a week or so ago, Warren Buffett issued a letter to shareholders in his investment company, Berkshire Hathaway. It was a Thanksgiving letter, time to coincide with Thanksgiving season. He always writes a letter, has for 60 years, he's written a letter within the annual report.
We normally talk about it in January
and that comes
or February.
in the spring, early in the year. And so this was a slight departure from the normal course of events. And the reason why it was a departure was because at the end of this year, he's handing on the reins to his successor, Greg Abel, running Berkshire Hathaway. He's 95 years old, but he obviously is finding it difficult to give up completely. He says he will continue to write a letter to shareholders in the autumn at Thanksgiving. He will no longer be writing the annual report letter. So it was published this week. I had a read of it. It was very interesting. It was a nice letter, and I thought it was a nice opportunity to revisit the sage of Omaha himself.
Yeah, and for obvious reasons, Tom, that you lay out there, his letter in the past week or so, and the most recent shareholder letters as well, have taken on a more valedictory feel. He's looking back, isn't he, on a long career. There is lots in there that's relevant to the market and to investors, but actually a lot that's relevant beyond that as well. Yeah,
I mean, I think, I guess this is what happens when you're halfway through your 10th decade. You become, perhaps a bit more philosophical. And I mean, Buffett has always been renowned for, what people call his sort of folksy style, his sort of Midwestern commonsensical approach to life. And but in recent years, you're right, as he's become a bit more sort of backward looking, if you like, he started to write really more about life than investing, I would say. Yeah. But I think what I found interesting about the letter was, so much of he's kind of lived his life. He's invested as he has lived his life. There's a lot of crossover between the two. His integrity and sincerity and honesty, are a key part of obviously of his life, but also they've been the underpinning of his investment approach.
Yeah, and let's look back, shall we, to Buffett's record, and as best you can, because there's lots of different ways you can come at this, but give us the sweep, if you can, Tom, of Buffett's numerical performance. And in particular, tell us how much of it came in the sort of distant past, because it's fair enough to talk about the distant past with Buffett, and how much is more recent than that.
Yeah, so Berkshire Hathaway has been going for 60 years. He's very usefully and helpfully sets out the performance in the annual report of every single year over that 60-year period. So, the numerical record is there to see. And it's a fantastic record. Over that period of time, the S&P 500 has delivered a total return of about 10% a year. and Buffett has delivered a total return of about 20% a year, which might not sound like a huge difference.
It does to me.
But, you do that every year for 60 years and it makes an enormous difference. I mean, I think off the top of my head, I can't remember the exact figures, but it's something like the total return from the S&P 500 is about 40,000% over that period. The total return for Buffett is 5 million%.
Those figures are always kind of mind bending, aren't they? But listen, they can hide a lot of things. Those figures, and it was probably true to say that there came a point in the sort of more recent past when those sort of like astronomical growth figures weren't really being generated by Berkshire Hathaway.
Yeah, I think that's fair to say, and it's a natural consequence of the growth of the fund. I mean, in the early days, when Buffett, clearly had an investment edge over the market for whatever reason, he was a good investor, and when you're investing a relatively small amount of money and you're good, it's possible to outperform quite significantly.
Yeah, absolutely.
When you're running, a massive fund, you are going to gravitate towards the returns of the market. It's very difficult to really to add some value, and Buffett's very candid about this. I mean, he says actually in his latest letter he refers to this. He says, one of the disadvantages of size is that it becomes very difficult to outperform. And looking forward, he says there will be other people that deliver much better returns than us, simply as a consequence of our size.
Yeah, we're going to come on to that about the future. But you mentioned the approach. There's actually been a couple, probably more than a couple of iterations of the Buffett philosophy over the years. It's all, within the heading of value investing, isn't it? For lots of people, those value principles are the sort of universal truths of how you invest. But how much would you say they also depended on the time and the place that Buffett found himself in?
Yeah, I think. Well, just before I come to that, I think you're right to say that there has been an evolution in the Buffett style over the years. I think to start with, he was very much a value investor. He looked for investments where the fundamental value of the company was greater than the stock market price of the company.
Real value plays.
Yeah. And I think that over time, and I think he was good at finding those, and probably this comes on to your second part of your question was, 50 or 60 years ago, it was probably easier to have that edge because there was much less information around. So I think it was easier to be a contrarian investor, to add value when there's a lot less information. I think it's harder now. But in terms of the evolution of his style, I think that as time went by, he became more interested in quality than in value. And I think he realized that you don't have to buy a bargain. You don't have to buy an investment at a bargain price to make good returns on it. If you invest in the best, if you invest in quality and you hold it for long enough, you will get fantastic returns. And there are lots of examples of that, investments that he's made over the years, the likes of Coca-Cola, Gillette, American Express. These are, companies that he has held for many, many years, decades. And they've just churned out great results. And over time, that compounds up.
Yeah, and it's really interesting. And what I kind of wanted to express in this conversation is this description of Buffett's career and the wider context of particularly of the American economy. And you mentioned a couple of the corporate names that are sort of synonymous with him and Berkshire and Coca-Cola, American Express, Gillette. These are in their way they'll show innovation, but really they're just doing what they do and producing something that people really, really, really like. A can of Coke, it's almost like the ultimate widget company, isn't it? Sort of Coca-Cola. Buffett has an eye for that, an appreciation for that, of brands and the power of that. And that coincided with an amazing expansion of kind of American consumerism in America and around the world. And it was an investing approach sort of tailor-made to win in that environment.
Yeah, I mean, I think, and in fact, Buffett mentions that he refers to this in the latest letter. He talks about the importance, the contribution of luck to successful investing, and he talks about his luck being born in 1930, in America, being reasonably intelligent, being male. Lots of everything, all the stars aligned for him, and I think the most important thing, his most important piece of luck, was to be investing at a time when America dominated the global economy, dominated global stock markets. And as you say, these great American brands became great global brands. And he was able to ride on the coattails of that. He didn't actually have to do anything particularly clever. He just needed to be there and to recognize the opportunity and to get on that bandwagon, and that's what he did.
Yeah, and recognize strong management. He always sort of puts a lot of stock in sort of the trust he has in the people managing the company.
Yeah, he talks a lot about finding good companies, not necessarily great companies, good companies managed by honest people. Yeah. And I think it all sounds very sort of applehood and
applehood and
motherhood and apple pie, but it worked for Buffett.
Yes, and that story, and it kind of takes us up to maybe the past 20 years, and then things have looked from an investment point of view less clear. And I think any fair conversation about Buffett should take note of the misses as well. And there have been some, haven't there? He was slow to get on board with tech. That's an obvious example. We're actually talking in a week where Berkshire's made a massive investment into Google.
Yeah.
And it's been an investor in Apple as well. Could you argue that investors today probably can't afford to be as value obsessed when the rest of the market is beginning to focus on, companies in newer markets, perhaps theoretically with lots of space to move into, but perhaps they don't have the numbers now? A value investor is not necessarily going to buy shares in those companies, but that's what you would have needed to do over the past 20 odd years.
Yes. I'm not sure about that. I'm not sure that the value question is the important question there. I think that you're right to suggest that he missed out on tech. He didn't miss out on it, but he was very late to the party. I mean, I think he first invested in Apple about 7 or 8 years ago, 10 years ago maybe. But he was late to that party. Has the world changed? I think that the evolution of his style to more of a quality style has naturally taken him towards the Apples and the Alphabets, which is what he's just invested in. And I think they possibly they play the role in the economy that the American Expresses and the Coca-Colas and the Gillettes played 50 years ago.
I think the Apple example is really interesting because Apple as a sort of tech innovator, he was less interested in. Apple as a consumer discretionary sort of company selling iPhones.
That's exactly right.
Suddenly he's interested because you're selling this thing that people love, they love the brand, and you're selling lots of them, and you're getting really good at selling that thing. That's when he jumped in.
That is exactly the right analogy. So the reason why Gillette was such a great insight as an investor was people shave. Well, some of us do, most days, and they have to keep replacing their jet. And in exactly the same way, people cannot live without their mobile phones. He recognised that this was a consumer item that people could not do without.
But the point being,
it's nothing to do with the tech.
Yeah, and the point being, there would have been people that got on board earlier because they were wowed by the tech.
Exactly,
and he wasn't. Yeah. It's hard to know, isn't it? Because whether what we're seeing in markets now will continue, right? I mean, it's a big question, but do you think there will be an investor who can come and do over the next 60 years what Buffett has done over the past 60 years?
I think no, they can't. And I think the reason is that in the early years of his career, there were many more value opportunities than there are now. I think because of the lack of information, there was simply lots of companies that were trading below their fundamental value. And so his insight into being able to spot those, I think that opportunity is no longer really there in the same way. But I think the second half of his career, the focus on quality, recognizing trends, I think that can be repeated. But I think it's extremely unlikely that anyone will have that fantastic combination of approaches over a 60-year period again. I mean, maybe they will, but I think it's unlikely.
Okay. Just finally, before we leave it, Tom, let's have a word on Berkshire Hathaway as itself. It's you described it as a fund earlier. It's a conglomerate, technically. It's a company, buys other companies and buys big stakes in other companies and shares as well. But Buffett himself has acknowledged, as you say, that it might not repeat those returns. It's unlikely to, but it has a sort of unique, or it presents a unique sort of opportunity for investors, doesn't it, Berkshire? Because basically it's got an absolutely massive amount of money, cash, in a big pile of cash people will talk about. And that's because it's harder and harder for it to find investments that it likes to sort of deploy that cash into the market. One of the effects of that is that people quite like Berkshire as a sort of downside protector in a portfolio, because if markets were to crash, Berkshire sat on lots and lots of money. That's quite good conditions for it to go out and make profitable investments for the future. People recognize that, and it kind of holds this unique position in the market.
I think that's right. I think Berkshire Hathaway is in a fairly unique position now for being, a pile of cash in the hands of people who are alert to the opportunity. So, there is downside protection. If the market falls sharply, then that pile of cash will be more resilient. But it's not just cash sitting in the bank. It is cash waiting to be reinvested. And so, I think it is very attractive to investors now for that reason. It's protection, but it's also opportunity.
Okay. Well, Tom, we've covered loads there, so we're going to leave it for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means that you'll get updated content as soon as it is released. Give us a like or share the episodes. It really does help people find what we're doing. That all said, Tom, thanks for joining me.
Thank you, Ed.